Hi friends, Namaste. Today we are going to talk about the Basel 3.1 framework. Globally, it is known also as Basel IV framework. RBI formally announced the implementation of the revised Basel 3.1 norms, specifically the revised standardized approach for credit risk on October 1, 2025 in its fourth bi-monthly monetary policy statement. Its draft directions were issued on October 7, 2025, known as Revised Asset Classification, Provisioning and Income Recognition Directions 2025. Its final version was published on April 27, 2026. Now, Basel 3.1 or Basel IV will take effect from April 1, 2027. So this period is available for the banks to upgrade its technology management and data management, risk weight assessments to sync with the requirements of Basel 3.1 to help banks absorb provisioning and capital shocks. Basel 3.1 is essentially the Basel Committee's final version of Basel III, which was introduced after the global financial crisis erupted in 2008. It also conforms with the IFRS 9 standards, and it is to ring fence the banks against risks under Basel IV framework. It covers revised standards for credit risk, operational risk, market risk, and it goes into a fundamental review of the trading book, output floor, and all related disclosures. It can be recalled that RBI has been implementing Basel III in a phased manner through capital regulations and related prudential norms, and is now in the process of aligning these to the Basel 3.1 standards for credit risk and other risk types. It's very interesting for us because the 3.1 framework will be applicable to scheduled commercial banks, excluding small finance banks, payment banks, and RRBs. It will not apply to them. It will apply only to commercial banks. The process begins with the first revising the standardized approach for credit risk assessment and related risk weights, then aligning the market and operational risk frameworks and the output floor over a multi-year horizon. That means this entire framework will be brought into full force in 2030-31. So we have the transition period of 3 to 4 years for us to work out the computation and then migrating to the new format. RBI's draft regulations on the revised standardized approach are the main Basel 3.1 credit risk implementation vehicle. More differentiated risk weights for corporates, investment grade versus non-investment grades, specialized lendings, SMEs, retail transactions, and also transactions versus revolving secured and unsecured loans, real estate exposures, different kinds of loans which carry different risks and different risk weights. So this has been brought into a granular format under the revised standardized approach announced by Reserve Bank of India. Tighter linkage between external ratings, due diligence requirements, and eligibility for preferential risk weights under the government-sponsored schemes and others. Henceforth, banks should not mechanically rely on external ratings. They must evidence independent credit assessment and ongoing monitoring to apply lower risk weights wherever it is necessary, enhanced borrower level data, income, collateral characteristics, loan to value ratio, product features, and is needed to classify exposures into more granular buckets and compute risk weights assets accordingly. So, the more precision is required to understand the inherent risks in the various kinds of assets that we hold to arrive at the risk weights so that the risk management system improves over a period of time. So that is why the different treatments have been given for different kinds of loans. Now, in the new Basel 3.1 framework, core capital structure under Basel III remains the same, like CET1, AT1 bonds, Tier 2, and regulatory adjustments continue broadly as per the Basel III frameworks, but it interacts with the revised risk weight assets calculations under Basel 3.1. Leverage ratio, LCR, NSFR frameworks also remain the same. So, the entire structure of Basel framework remains the same, except a more realistic, granular computation of risk weights will be involved, for which lot of data collection, data mobilization, and data analytics will be required to implement Basel 3.1 framework, which may give banks some kind of a relief in the form of lower risk weights for certain categories of loans, and it may attract a higher risk weight for risky assets. So one has to be very, very careful in computing under the new regime. The Basel 3.1 framework proposes a very distinct feature known as output floor. Now, we should understand what is output floor, because this is the crux of Basel 3.1 or Basel IV framework. It sets the limit of 72.5% of the total risk-weighted assets calculated under the revised standardized approach. Now, let us try to understand this. Now, banks in India have to calculate risk-weighted assets under standardized approach. Number one, till now, we have no bank in India is permitted to migrate to foundation IRB approach or IRB approach. Now, when we subsequently migrate to those higher formats of credit risk assessment like IRB approach, and when we compute the risk-weighted assets, suppose in IRB approach, against 100 units of loans, you get risk weights of 60, and under standardized approach, you get 100 as the risk weights. Then you cannot apply 60 as the risk weights for that portfolio. You will have to minimum maintain 72.5% of risk-weighted assets under standardized approach. That is the output floor ceiling, where you cannot have risk weights lesser than 72.5% computed under the standardized approach. So, standardized approach and IRB approach simultaneous computation is necessary to ensure that you remain at 72.5% of the standardized approach. The reason for the output floor is that globally, banks using advanced internal rating models are generating vastly different risk weights, which may undermine the actual capital that is required to be maintained against risk-weighted assets. Because if the risk-weighted assets are less, capital requirement will be less automatically. Some banks aggressively optimized internal probability of default, loss given default, other models to suppress risk-weighted assets and reduce capital requirements, thereby underestimating risks. To circumvent this, a checkpoint of output floor has been defined so that the banks cannot maintain risk-weight assets less than 72.5%, which is computed under standardized approach, even if under IRB approach, it works out to be far less. So, this is a checkpoint that has been created, and banks cannot circumvent the capital requirements using this new method of computation. Revised RWAs as a result of this computation under 3.1 will shift capital intensity across product segments, likely increasing capital for high risk retail unsecured exposures while giving more risk sensitive relief where banks maintain robust data, collateral, and due diligence. So, under Basel 3.1, while we maintain the standardized approach in the computation of risk weights, the granularity of information, the detailed classification of the loans, classification of the collaterals, classification of the different means to assess the risks will have to be computed very meticulously. So, the new Basel 3.1 in the long run is good for the banks as the risk weighted assets will sync with the intrinsic risk which is inherent in that particular asset. So, it is very good as far as the Basel 3.1 is concerned. So, we will have to make lot of groundwork to collect as much of granular data from the operations as possible to see that the risk weights are realistic, are aligned to the riskiness, and we are able to comply with the regulations of the new regulations. And maybe some of the banks will be able to save some capital out of the new computation methodology if they can mobilize more granular data and justify the risk-weighted assets. But as of now, the all banks in India will be following the standardized approach of computation of risk weights. So, output floor will not remain very relevant for the banks in India, but as we graduate to IRB approaches, then output floor will come into picture, where the banks cannot have risk weights less than 72.5% of risk-weighted assets computed under standardized approach, even if the IRB approach shows less risk weights under the dispensation of IRB approach. So, it is a very good development as far as the banking system is concerned. We will become more sensitive towards not only the loans, but the granular information and also about the underlying securities that keep the loans safer, and our risk-weighted assets will be more aligned to the actual riskiness, and we will be able to perhaps reduce some risk weights and capital requirements in the coming times. So, we will be discussing more about these kind of developments in the times to come. Till then, I would request if you want any particular topics to be dealt with, kindly put it in the comment box. If you like our work, please like it, share it, and if you have not so far subscribed to this channel, please do subscribe as it will be encouraging us. And we will come up with more discussions on BFSI sector, particularly the banking sector, on which this particular channel is dedicated. So, wish you all best of luck, and thank you for watching, and keep in touch. We will be happy to be of use to all of you and disseminate the knowledge. Thank you for watching.